In this video, we'll discuss the differences between stock dividends and stock splits. Let's look at stock dividends first. A stock dividend is when the board of directors gives earnings of the companies back to the owners. They give them in the form of dividends. They give the dividends in the form of stock instead of giving cash. They might do this because they don't have enough cash on hand, or perhaps they're trying to save up for a larger purchase like a new building or new equipment, and they don't want to pay out cash at this point. So they'll choose to give the shareholders back stock. Stock dividends do not affect total stockholders' equity. They simply move money from retained earnings into common stock and possibly paid-in capital. There's two categories for a stock dividend. There's a small stock dividend and a large stock dividend. A small stock dividend is when 25% or when less than 25% of the outstanding shares of stock are declared as a dividend, and we will use the market value of the stock to record the value in retained earnings. A large stock dividend is when the company decides to give 25% or more of the outstanding shares of stock out to shareholders. This one will use the par value instead of the market value. Let's look at some examples. The first one, a company has 250,000 shares of $1 par common stock outstanding. Remember, dividends are always calculated based off of shares outstanding. On March 1st, the board of directors decides to declare and immediately issue a 15% stock dividend when the market value of the stock is $18 per share. Since the amount of the stock is 15%, that makes it a small stock dividend, and we will record in retained earnings using the market value. So, let's work on the entry. To prepare the journal entry, we first want to take the earnings of the company and give them back. Where do we store earnings from the company? In retained earnings. So we're going to debit retained earnings for $675,000. How did we get $675,000, you ask? Well, we take the 250,000 outstanding shares, we multiply it by the dividend percent, which is 15%, and then we multiply it by the market value of $18. What is it we are giving the shareholders? We are giving them earnings of the company in the form of stock. So we're going to record common stock. We always record common stock at its par value, and this par value happens to be $1. So we'll calculate the 250,000 shares outstanding. We'll again multiply by the 15% stock dividend, and this time we'll multiply by the $1 par value. Notice my debits don't equal my credits, which is a very bad thing in accounting. So we know that we need one more thing. Whenever we have a difference between the market value and the par value of stock, we put it into the account called paid-in capital in excess of par for common stock. So it's just the difference between the market value and the par value, and it comes to $637,500. That's not too bad, right? With me? Great. Now let's look at a large stock dividend. So a large stock dividend, the problem looks basically the same. This one says a company has 250,000 shares of $10 par common stock. On March 1st, the board of directors is going to declare and immediately issue a 35% stock dividend when the market value of the stock is $18 per share. The good news is we don't need to know the market value. Because this is a large stock dividend, that means it will be recorded at the par value. So on March 1st, we're going to take it from retained earnings. All dividends come out of retained earnings because a dividend is earnings of the company given back to the owners. How did we get $875,000? We took the 250,000 shares times the 35% dividend times its par value of $10. We will also record common stock $10 par for the exact same value. The calculation is the same. 250,000 shares outstanding times our 35% stock dividend, and our $10 par value. Notice, we do not have paid-in capital when there's a large stock dividend, since it's always recorded at par value instead of market. So large stock dividends are recorded at par, small stock dividends are recorded at market. Now let's move on to a stock split. A stock split is a very interesting type of thing that a board of directors may choose to do. Perhaps the company doesn't have enough money in retained earnings or cash to give earnings back to the owners, but they also have noticed that their market price is too high right now, and they want to encourage people to invest in them. So they might, at that point, give a stock split. A stock split is when the owners decide to give more shares, but they just decrease the par value of the stock. To a normal person, you and me, a stockholder, the par value of a stock means absolutely nothing. So all this means to us is we're getting more shares of stock. Stock splits do not require a journal entry. They do not change any of the account balances within the equity section or total stockholders' equity. So you may be asking, what's the point? Well, what it does affect, it increases the shares of stock. We're going to multiply the shares times the stock split. This is going to include all types of shares, authorized, issued, and outstanding. At the same time, we're going to decrease the par value of the stock. We're going to divide the par value by the stock split number. For an example, a company has 250,000 shares of $10 par common stock authorized and 200,000 shares issued and outstanding. The board of directors decides to issue a 5-for-1 stock split on December 1st. So what happens first? No journal entry is created or required. Why? Because we are not changing the dollar amounts or any of the account balances for any equity account. The shares are multiplied by the stock split number of 5. It's a 5-for-1 stock split, so we're going to take every one share and tear it into 5 pieces, or make it 5 shares of stock. So that means that the authorized shares were 250,000. We multiply those by 5, and we now have 1,250,000 shares. Issued and outstanding, we had 200,000 shares. We're going to multiply that by 5, and we now have 1 million shares issued and outstanding. What does that do to par value? Par value is divided by the stock split number of 5. So we had a $10 par. We divide it by 5. That means our par value is now $2 per share. The company now has 1,250,000 shares of $2 par common stock authorized, and they have 1 million shares issued and outstanding. Notice how common stock before the stock split was $2 million, calculated as the 200,000 shares issued times $10 par. After the stock split, it remains $2 million. We just have 1 million shares with a $2 par value. So a stock split is just taking a bigger piece of a whole and dividing it into smaller pieces. The value doesn't change, just the value per share changes. I hope these answers your questions, and I hope you enjoy watching this video.